What looked like a promising start to the day in the U.S. stock market did quickly fizzle as we headed into the close. Many of the indices did close near their lows of the session. In fact, all of them did close in the red, while at one point during the session being positive. So a little bit of a role reversal as the day went on. So we'll take a look at that and see what it means for our posture. Then we'll get into our trade application example where I wanted to focus on one of the main indices. In fact, a trade that I had done last month that has now successfully rolled off our books, I wanted to re-implement once again for the coming month as I'm seeing a very similar setup. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 25th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then sign up for our distribution list, email distribution list down below. We also have a heavy presence on Twitter. We enjoy engaging with you guys on Twitter throughout the day between presentations. If you're not following me already, feel free to do so. My handle is @BrandonVanZee. In fact, I'm only about 15 or 20 people away from the big round number of 10,000 followers. So if you're not there yet, go ahead and help me along with that if you don't mind. We really appreciate those of you that click like and retweet on our Market Outlook related tweets as well. And then last but not least, we have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's activity. And you can see I've got chart 4B pulled up here in front of us for those of you that are premium members following along at home on your own charting package. So as we're looking at this, you can see that the S&P 500 ended up lower by 0.21% today. Now, that wasn't a big pullback. More to the point is that it looked like it was a pretty promising opening and then did fade as the day went along. Now, where things stand is not all that disruptive. We still have a strongly bullish posture. Notice the background color of the chart is still dark green. That is signifying that this green intermediate line is rolling back higher and is above 50. So remember, anything in the upper reversal zone would be considered strongly bullish. But if the line is below 80, if it's between 50 and 80 and rolling up, that would also be a strongly bullish intermediate posture, and that's why the background color is dark green as opposed to the light green that we saw over here when the green line was below 50 for a little bit of time. So that's a good sign. The S&P 500 still remains reasonably strong. It probably still looks like the strongest one of the four on the board here in front of us. You'll notice that the green line, the green moving average, signifies that price is above a rising 30-day moving average in this case. So a good sign there. Another thing that I would mention is that we do have what's known as a bullish intermediate confirmation signal on the S&P 500 at this moment in time. That occurs when the green line is in a positive spot on its indicator, and the red line is in the low reversal zone at the same time. So a lot of times when we discuss these bullish intermediate confirmation signals, the green line is actually in the upper reversal zone. That is considered bullish, just like what we have right now is considered bullish. If it's in the upper reversal zone, it's considered probably more bullish. So this would be one of the less ideal forms of the bullish intermediate confirmation signal. Not only that, but you can also see that the blue line here is close to the upper reversal zone. Ideally, we'd like to see the blue line between 20 and 50 on the day that we get the bullish intermediate confirmation signal. Remember, the bullish intermediate confirmation signal is effectively a buy the dip signal. What it is expressing is that the intermediate posture is bullish, and at the same time you have a momentary short-term pullback in price. Now, we did receive that today, but let's be honest, a 0.21% pullback is not all that dramatic. So some folks might decide they want to wait for a little bit of a stronger pullback to get a slightly better pricing. But I would mention it there just because that signal does exist. As we look at the Dow Jones Industrial Average, we also have that signal here. This one is even less impactful. And the reason for that is the green line is not above 50, right? Over here on the S&P 500, we do consider this strongly bullish because it's rising between 50 and 80. Over here on the Dow Jones Industrial Average, it is rising, as you can see in the label there, but it's only at 44. In other words, it's not above the 50th percentile yet, so we would consider this to be a weakly bullish posture. It's not bearish, but it's only weakly bullish, not strongly bullish, and therefore this bullish intermediate confirmation signal is not nearly as interesting. So neither one of these I would call ideal, but of the two, the stronger chart is the S&P 500 at this point in time. The Dow Jones, just to put a bow on it, was down 0.24% today, so nearly identical to what we saw out of the S&P 500. Let's move on to the bottom charts now, where we have some differences. You can see that in both of these charts cases, we have a red moving average. And what that suggests is that we have price below a falling moving average. That is different than the two green moving averages we have up above with the S&P 500 and the Dow Jones. So on the NASDAQ composite, remember that's a tech-heavy index, oftentimes chocked full of growth companies and disruptive companies. And in 2020, they were the bee's knees. They were the best place to be. 2021 has not been nearly as kind to those types of companies. So they're struggling on a relative basis compared to a lot of the big blue chip types of companies out there, some of your dividend aristocrat types of companies and those sorts of things. And by the way, I taught my dividend growth investing class earlier today. If you're interested in a conversation about the utilities sector, feel free to check out that recording if you are a plus or a premium member. But for our purposes here, where we're looking at more technical analysis, I would say that things don't look entirely attractive for the NASDAQ composite, despite us having a weekly bullish posture here. So of the two, again, note that we have this light green background color on the Dow Jones Industrial Average today. We have that same light green color on the NASDAQ composite, but when we use additional analysis beyond just the market forecast, I would certainly prefer the chart of the Dow Jones over the NASDAQ composite. The NASDAQ composite somewhat scares me at this exact moment in time because we're sitting right underneath that falling moving average. And so it always sets up that possibility that this will be used as some sort of a resistance area and we push back down and away from that falling 30-day moving average. You'll also notice that we kind of have an important point here on the chart from a technical analysis perspective as well. If I were to get my drawn items out, maybe I can draw it here for you so that way you guys can see exactly what it is I'm referencing. That blue line that you see on the NASDAQ chart there, you'll notice that that was used as a support bounce area back here on April 20th and April 21st. So a lot of times what you find is kind of this breakdown retest in a bearish scenario like this. It's kind of like the 180-degree opposite of a breakout retest. This is a breakdown retest where you had an initial support, you came back down to that level on the 4th of May, where you're holding out hope that it would act as support once again and bounce up and off of it, but instead you slice straight through it. Then you have this kind of reflex rally back up to approximately the same area, where technicians might use that as an excuse to now say that that is a resistance area. So you kind of have a coincidental horizontal resistance along with more of a diagonal resistance if you use that 30-day moving average that's slumping over right at that exact same level right there. So I'm a little bit more cautious around the NASDAQ right here. It's been a good rally off the lows for the last couple of weeks. So I think those that have been in some of those growth stocks have been bailed out to a degree. Now might be one of those times where you play it a little safer once again until we start to have a little bit more comfort in the charts. Naturally, if you're going to expect the NASDAQ to break out to major new all-time highs and going back into an uptrend, you're going to need to see it start establishing a presence above its 30-day moving average. And right now, we haven't been able to make that claim since going back here to basically the end of April. So it's been a long month of May for those tech stocks. The first part of the month started with a sell-off. The second part of the month has seen a bit of a rally, but we still are shorter from where we were falling from a month ago. And so all else being equal, we got to be a little bit more cautious here, despite having that weekly bullish posture according to the intermediate line on the market forecast. The Russell 2000 looks even worse. So out of the four, from my eyes perspective, the Russell 2000 is the one that is the most concerning if you're bullish. If you're bearish, you're licking your chops, because this is exactly the type of setup that you're kind of looking for here, where you've got a lot of the similar kind of tendencies as the NASDAQ chart, where you had a lot of time above the moving average on this chart, but then it slashed through that moving average. We had this reflex rally back up to that falling moving average, and this morning it was actually above it for a while, but we actually closed basically on the dead lows of the Russell 2000 here. So not only is it rejecting that falling 30-day moving average, you can see that it engulfed the last 2 days' bodies, which is generally considered bearish. And you can also see that this red colored background is starting to creep into the picture. What that suggests is that we now have a strongly bearish posture on the Russell 2000. The reason for that is this green line has now rolled over. I know it's kind of hard to see with the naked eye, but that's why we have these labels here to help us along. And it says that the intermediate line is at 39 and falling. So remember, if it's between 50 and 20 and falling, we consider that to be strongly bearish. And so that's why the background color is now changed to that dark pink there. So of the four, I would say the best looking chart at this point in time, if you're bullish, is the S&P 500. The worst looking chart, which would appeal to those of you that want to be bearish, would be the Russell 2000. But naturally, those things do change, so you want to stay engaged in the market and see how the technical analysis changes from day to day. But right now, that's kind of how I see things. Let's go ahead and move along to our 3 green arrows chart. Let me get rid of that drawn item before I forget about it. There we go. Let's go over to our 3 green arrows chart now. This will be chart 4D for those of you following along at home. As we're looking at this chart, it kind of confirms what I mentioned just a moment ago, which is the best looking chart on the board is probably the S&P 500. Now I can make that claim in this case because this is the only one on chart 4D that has a green background color, which suggests we have a 3 green arrows setup with the S&P 500. Green arrow number 1 on the moving average, green arrow number 2 on the MACD histogram, and green arrow number 3 on the stochastics. Notice that our other 3 charts have a white background color behind their current candle, telling us that there's a mix of green and red arrows. That's I guess the nice thing about the Russell 2000, despite having a strongly bearish intermediate posture according to the market forecast technical indicator, it does still have a green arrow on the MACD histogram indicator and the stochastics indicator. We'll see how long that lasts. Naturally, if there is a further sell-off tomorrow in the small caps, that sets up the possibility that we might actually be going to a 3 red arrow status on the Russell 2000 fairly quickly. So we'll see who wins this tug of war right now. You got the kind of the big caps in the S&P 500 doing its best to try to pull the market higher, and then you got your small caps in the Russell 2000 kind of trying to pull the market down, and then the other 2 charts are kind of in the middle, balancing things out. So it's a little bit of a different type of a market, where we've got different directions at this moment in time. And I will say that in 2021, it's kind of felt like that has been the case more often than it is in typical years. A lot of times these indices do move in unison with one another to one degree or another, but it does feel like 2021 has been a different type of a market, where it started with such an interesting flavor, where the market immediately went from disliking oil companies and banks to immediately falling in love with them with the flip of the switch once January 1st hit. So that kind of just shook up everything along the way. And of course, a lot of that is being driven by interest rate activity, also being driven by the prospects of reopening the economy. Last year was a year when a lot of the e-commerce and digital and work from home and all those kind of things worked really well in the stock market. Now that the economy is opening back up again, we're starting to see them spread the love a little bit more to a lot of other sectors that were kind of left out of the party last year. So it has certainly been a different type of a year, but we've managed to navigate it quite well, not only here in my presentations for the market outlook, but we've had a lot of success in all of my premium trading rooms as well. So I'm happy with the way things have been going for sure. I know it could be a lot worse out there. All you have to do is look at Twitter and get a sense of what somebody's grumbling about at any moment in time. And these days it seems like a lot of the growth and disruption disruptive companies are the ones where it's causing a lot of angst for people. But fortunately, we just haven't had a lot of exposure to that here in this presentation. So I am thankful for that. All right, let's go over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support the Market Outlook presentation here. Remember, this is a product that is free of charge, so we need to be motivated in order to take a couple of hours out of our day to record the videos and research the trade setups and send out the notifications and editing the videos and everything that goes into it. So we have the hard end of the bargain. You have, I would like to think, the easy end of the bargain. All I ask out of you is simply to click like for us on Twitter. It only takes 5 seconds out of your day. Also, while we're over here, looks like I'm at about 9,986 followers here, only 14 more away from that big 5-digit number of 10,000 followers. So if you're not following me yet, I would encourage you to do so as we close in on that big round number right there. Last time I did the video on the 20th, 115 of you clicked like. I really, really appreciate you 115 out there, in addition to those of you that are retweeting it as well. So thank you to Sedona and Valerie and Margie and Bonnie and Julie and Paul and Mary and Deborah, Ken, Dave, Monesh, Kirk, Paul, Bumblebee, Ray, Linda, Joe, Craig, Dale, Surendhar, Gordon, Donald, Mike, Ken, Kenneth. There's a whole bunch more that I'm not going to be able to get to, but you get the point. I really appreciate you guys. We do see it when it comes in, so we know you're helping support us. We thank you for that, and that's what you can do to help encourage us to do these videos as often as possible. A week from today, on that note, I might be taking the day off on Tuesday. I might be tacking an additional day off on my 3-day weekend, a rare chance to get out of town. It'll actually be my first time out of state since before the coronavirus. So I'm kind of itching to get out and kind of unplug for a little bit. So be aware that there's a chance that a week from today I will not be able to do the video because I'll still be on my vacation. But anyway, we appreciate your likes nonetheless. Also, while we're over here on the internet, let's take a peek here at the sector selector. Remember, I update this on Friday evenings traditionally with that week's data and statistics to kind of filter into these different ranking systems that we use. This particular graphic is used most particularly in my Monday top-down trend trading class. So if you're interested in sector rotation and how to take advantage of the movements we see within the market, feel free to join that particular class if you're a premium or plus member. So we didn't really have a lot to speak of in terms of rotation week over week. In fact, our top 4 slots stayed exactly the same. Energy continues to lead. Financials are right there behind it. Materials, a strong number 3. In fact, materials and financials have been really, really close as far as who comes out on top. Financials has been able to hold off the materials, but we'll see if that continues or not. They're right there neck and neck. And then the industrials have kind of crept back into the top 4 there. We actually ended up buying a company in the transportation and freight industry in my Monday top-down trend trading class this past Monday within that industrial sector there. On the downside, utilities continue to lag. However, I would like to point out that we did have a change in the 9-10 ranking. Healthcare did get up and over the consumer staples last week. And some of you might have even heard me mention on Thursday's Market Outlook presentation that I was really liking how both the real estate and the healthcare charts were setting up. And so we can see the evidence kind of flowing through here into the sector selector there as well, at least in the case of healthcare. So I'll be curious if that can continue as we head into the American Society of Clinical Oncology presentations that will take place the first week of June, which is a big healthcare conference that usually ignites some of those more interesting healthcare stocks that are out there. We did see communication services in the middle of our rankings supplant consumer discretionary in that 5-6 slot there as well. I've noticed a lot of those apparel related names have kind of taken a bit of time off after having a really nice run of things earlier in 2021. So we'll see if that continues to be the case going forward or not. All right, let's go ahead and get back on over to the Thinkorswim platform and look at some more charts. Let's do some 12 grid analysis, starting with chart 5A. This will be our asset class 12 grid. As you're seeing with the charts in front of us, the assets all look pretty good on the whole. Now, obviously, we're looking at everything from stocks to commodities to interest rates and bonds and all kinds of things here. So you rarely have a clean sweep of green or a clean sweep of red. But in this case, there is more consistent green backgrounds when we're looking at these particular charts. The odd men out, or the odd women out, however you want to phrase that, are the ones on the bottom rung. In particular, the US dollar continues to be a problem. It continues to fall pretty precipitously, regardless of some of these oversold cluster signals that we're receiving here along the way. Remember, a lot of times those oversold cluster signals can start that process of hammering out a bottom, but that's just not in the cards here for the US dollar yet. The fall has not been as sharp as it was initially right here after getting that overbought cluster signal. That was a pretty deep fall off right there initially. The falling of that chart has kind of slowed down. It has continued to go lower, but it hasn't gone down as rapidly as what we saw over here. So we'll see if there's ever any sort of major reversion to the mean. We got a little bit of a reversion right there, another one right there, but we really haven't gotten any here in the last week. We've really just kind of gone sideways with this cluster and the one that we received yet again here today. So that's been a house of pain for people who have been involved in long US dollar assets. Fortunately for most stock investors, we actually cheer on the demise of the US dollar. I know that sounds unpatriotic, but the truth of the matter is we have a lot of global businesses in the United States that do, in some cases like a Coca-Cola or Procter & Gamble, they do more business outside of the US than inside of the US. So for those multinational businesses, they actually benefit when the dollar is falling. You also have a lot of support of commodity related names out there when the dollar is falling. So all else being equal, if I had it my way, I would want a slowly deteriorating dollar. I don't want some sort of major market dislocation because that can startle the market. But in general, if I had it my way, I would want that dollar to deteriorate very slowly as time goes on. That's usually accommodative of stock prices. And so as a long-oriented stock investor, that generally helps me whether people recognize that or not. Anyway, with that dollar falling as much as it has in the last couple of months, it should not be a surprise to see gold having the time of its life. Take a look at GLD right here. What a day it had. It was up nearly 1% today, which, remember, that's a big move for a big commodity like this. We're not talking about a growth stock or anything like that. We're talking about an entire commodity that has a worldwide audience. And so gold bursting to new multi-month highs here. We're not at all-time highs. Got a ways to go there, but this has been a really impressive turnaround that we've identified for you week after week after week during this stretch of time in the Market Outlook video. So if those of you that watched the free video just took one bullish trade on gold or a gold miner along the way, it was probably worth your while to check out our videos. So anytime we see anything interesting that's catching our eye, we try to share that with you. And in this case, we were all over this idea as we were sharing the bullishness as soon as it got above its moving average there and has continued to burst higher off of that. And we did take a long gold mining trade along the way that was successfully closed at max gain in this presentation. So happy about that. Oil has not been as sharp of a rally in the last 3 months. That's partially due to the fact that the beginning of the year, oil was quite strong. And so we've seen more of a flattening out of the trade. I know you can't see that on this chart right here because this is only 3 months, but prior to this 3 months, in January and February, you had really strong oil prices. They've continued to go higher, all else being equal. You can see even in the last 3 months, it's up about 6%. So it just doesn't look as sharp here in the last 3 months because gold was not nearly as strong in January and February. So it was kind of bouncing off of a deeper decline during that time period, which makes the follow-up 3 months look more impressive. But on the whole, oil has actually outperformed gold in many different performance periods beyond this 3 months that we see right here. In these 3 months, we see gold up 7%, oil up about 6%. So they're about neck and neck there, but of the two, the better looking chart is certainly gold in this case. But what I will say for oil is at least it's still trading above a rising moving average. There's a lot of talk these days about an inflationary expectation going forward. That can oftentimes be supportive of these commodity-oriented areas like gold and oil. We did see that interest rates fell here today. And so remember, I've got that bullish trade on for TLT that wasn't looking so hot about 2 weeks ago as TLT was sharply falling those 4 days right there. But I remained patient with it. We didn't have a knee-jerk reaction and get out of the trade or anything like that. We stuck with our original thesis, and now we're being rewarded for our patience with that trade. Now remember, when I do trades, not only for the new trades for these videos that I do on Tuesdays and Thursdays, I send out the trade alerts via our Telegram app to our premium members, but anytime I adjust our trades along the way or make management decisions on our open trades, I also send out the trade alerts on that. So sometimes you guys might be wondering, well, did you get out of that trade yet? No, I haven't. I'm sticking with it. So, and like I've mentioned to you guys in the past, I am not a bond bull for the long term. That's what differentiates my mindset between TLT and GLD. GLD I actually do like for the longer term. Bonds I do not. Bonds I chose to take a bullish trade on as a moment in time where I felt like they had really fallen spectacularly at the beginning of the year, and I felt like there was probably a time for them to stabilize a bit, and that's the time that we're in right now. So I am happy to see TLT back above its moving average just for the sake of that bullish trade that I have going on right now. We're looking really good with that trade. Remember, it was a bull put spread, so we don't need some sort of a sharp move higher in TLT. We just need it to go sideways, and we're good to go. So from that perspective, good to see interest rates falling a bit today and bond prices rising a bit today. In terms of other charts on the board, Bitcoin was down 2% today. And it has a weekly bullish posture, not a strongly bullish, but a weekly bullish posture. However, I think most of us that look at this chart would suggest that this is not a great looking chart. So like I mentioned to you guys last week, if Bitcoin somehow manages to get back up to 47,000, I would view that as a strong resistance area. And until it can break that area, I'm not going to trust it any further than I can throw it. And it's not to say that Bitcoin can't have spectacular success over the long term, but in the next 2 or 3 months, my assumption right now is that there is a lot of pressure within that cryptocurrency because I think a lot of people got startled with that sharp sell-off that we saw here in the past week or two. So right now, yes, it's true that the intermediate line is at 21 and rising, so it's barely out of that lower reversal zone at 20, and therefore it is considered weekly bullish, but I don't think I would be overly ambitious with it at this point until I see more constructive chart activity here. And right now, it's starting to look like a pretty heavy chart. So I would say tread cautiously, as if you didn't know that already, right? Most people, when they enter into the cryptocurrency world, know they're already taking a tremendous amount of speculative risk. But it's even more so the case when the chart looks as though it does right here, right now. In terms of our charts up at the top with our stock indices, I would say that EFA actually looks stronger than the S&P 500. That's a good looking chart right there with EFA. Remember, EFA are the foreign stocks from the developed markets, so think about a lot of the European countries, Japan, Australia, as opposed to the emerging foreign stocks, which are China, India, Russia, Brazil, those types of emerging economies. They don't look nearly as good. Remember, in some cases, they're still struggling with the coronavirus and other things going on there. So the place to be right now appears to be developed foreign stocks. There's a really nice burst higher. Remember, that plays into the theme that I talked about earlier as well with this falling US dollar. The further that the US dollar can fall, the easier it is for foreign assets to outperform on a relative basis. So if you expect the US dollar to continue to fall, then EFA could very well end up being a very interesting trend trading opportunity going forwards. We'll see how that all plays out. Let's go ahead and take a look at our sectors now. This will be chart 5C. And as we're looking at chart 5C, you can see a little bit of a mixed bag here, depending upon which sector you want to focus on. One of them that surprises me a little bit is materials, because materials had looked awesome for so long. And even right now, if you were to just forget that you see the pink background color and just look simply at the chart, I think most of us would agree that's still a significant uptrend. But it is true that there's been a little bit of touch and go here in the last week or so, where we haven't been able to get up and over that prior high that the materials set on May 10th. So that might be a little bit concerning right there. So we'll keep our eye on it, but until it gets below its moving average, I think I want to give the materials the benefit of the doubt. A lot of those steel names and iron ore producers and other heavy commodity types of plays out there are actually trading at reasonable valuations right now, despite the big run up in prices. And so I'm not going to count the materials out until we start seeing a breakdown of support below the moving average. At this point, we don't have that yet. So it's maybe just a heads up that there's some storm clouds in the sky. We just don't know if they're actually going to lead to a legitimate storm or whether they're just going to blow out of the system and we're going to end up having sunshine once again. So that one we'll keep our eye on. It's a little bit surprising to me. The chart that doesn't look so hot from a price perspective is utilities. Notice that utilities has broken down the last couple of days. We're now trading below a rising moving average. That's why the moving average is yellow in this case today. The moving average is rising slightly, but price is now below it. So it's kind of conflicting signals if you think about the traffic light scenario, red, yellow, green. When you see yellow, it means yield or cautious. We have conflicting signals. We have price below a moving average, but the moving average itself is still rising. That will get resolved one way or another in the future, and we'll find out all together here. But right now, that is the only chart on the board that has a dark pink background color. And judging by what we just looked at a moment ago on the sector selector, remember, I'm using completely different evidence to create that sector selector. But so it's nice to see that what I'm looking at here on this 12 grid kind of confirms what my other research suggests, which is utilities are the area on a price perspective that are struggling the most. So if you're looking for value opportunities or higher yielding opportunities, perhaps utilities is a place to be. But if you're looking for price momentum within the stocks, that's an area that's got a little bit of wear and tear here all of a sudden. So that's the one that's kind of the more obvious avoid technical analysis chart that we're looking at here. In terms of the charts that are looking a little bit better, I'll once again point out that real estate is still shaping up quite nicely. In fact, I believe, if I'm looking at this the right way, that on an intraday basis, real estate did hit a multi-month high here. Let me just right-click and maximize the cell, and I will double-check. Yeah, at the height of today's candle, that was above this candle and this candle over here. Now let's see how far that will take us back. On a 3-year chart, yeah, this is actually going to be, I believe, an all-time high. Now remember, XLRE was not created as long ago as most of the other sector ETFs, so we can't go as far back to check because the real estate companies used to be part of the financial sector, but then they were kind of split off back here in 2015. So over that stretch of time, this is what appears to be an all-time high here for XLRE, the real estate sector ETF. And that is saying something, ladies and gentlemen, because one of the areas that got absolutely decimated during the coronavirus pandemic was real estate. Look at this sharp candle that we saw here. Now, these are monthly candles that we're looking at, but this will give you a sense of how extreme the move was in the month of March of 2020. So there were a lot of, let's say, commercial real estate areas, office buildings, and other areas that knew, like commercial, not only commercial, but retail, right? When we're all locked up and the pandemic is having us, wear face masks, we don't want to be out as much. These are like some of the worst conditions you could ever imagine for a lot of these different areas of real estate. Yet what we're seeing right here in front of us is a spectacular recovery in real estate. So we haven't seen them go up as much on a percentage basis as something like technology, but in a way, what they've accomplished is equally as important, because I think the deck was stacked much more against real estate than it was technology. Remember, technology in some ways actually benefited from the coronavirus because of all the work from home and all the e-commerce and digital plays that started to pick up. So in a way, this is one of the more impressive things that you would have been able to see in the last year or so. An impressive move there out of real estate. So that's the chart that's kind of catching my eye as being maybe a little bit more interesting all of the sudden. Let's go ahead and get into our trade application example now. For that, I'm going to go ahead and pull up chart 4A, and we are going to pull up ticker symbol IWM, and those of you that have been involved in the markets for a while will certainly recognize this one. This is a very popular ETF that tracks the Russell 2000. So this is a iShares version of it, iShares Russell 2000 ETF. And just like when we were looking at the rut at the beginning of this presentation on our 4-grid, the IWM is going to emulate what we saw there. In other words, a really ugly looking pattern here. And so we were looking earlier in the day like the Russell 2000 maybe wanted to do a little bit of a breakout, right? We were trading well above that falling moving average. In fact, we had cleared above the price high back here on May 18th, but it just simply wasn't in the cards. It spent the rest of the day selling off and basically closing dead on the lows, right? That's what that filled in red candle means. It means that we started high, we ended low. And remember, it's not how stocks start, it's how they end. I'm sure David has told you that a million times because that's something I hear him state often, and it is true. It's not how the stocks start, it's how they end. And it was a really heavy close to IWM, which is another benefit for those of you that are premium members of Market Scholars. You know, knowing that I placed this trade earlier in the day when the market was open, and now knowing that this particular ticker symbol closed at the lows of the day, naturally we're up on a bearish trade right there. Not to say that that's going to happen regularly, but it is a benefit, a nice perk for those of you that are premium members to receive this information before everybody else who's watching the free YouTube video later on that night, because they might not be able to make a trade until the following morning, and by then maybe the trade is already out of hand. Maybe we have a big gap down tomorrow. We'll just have to see how it shakes out. But right now, I am happy I got the trade in before the close because we did close at the lows of the session. And another thing that kind of caught my eye with this, by the way, was we have a little bit of a bearish near-term divergence. Notice down below there's this blue line that represents the near-term line on the market forecast. On May 18th, we had a peak in that blue line. On May 24th, we had a secondary peak. Now notice that secondary peak is well below the primary peak. Primary peak is in the upper reversal zone. Secondary peak is just under the upper reversal zone. Now notice the candles on those 2 days and where they closed. On this day up here, IWM closed at 219.64, and on this candle here, it closed at 221.40. In other words, a couple of bucks higher in price at a time when the underlying indicator was suggesting that there's some bearishness that not everybody is picking up upon. So now that we have this bearish engulfing candle of the last 2 days' bodies and a rejection of that resistance area at the falling 30-day moving average, which has now pushed our posture into a strongly bearish condition here, according to the background color being dark pink now with that green line at 40 and falling, this represented a very interesting bearish trade setup. Obviously, it doesn't guarantee a darn thing, but we took a trade very similar to this a month ago, and that one was successfully closed at max gain, and I like the way this one is looking so far. Now, keep in mind, the Russell is going to be in focus in the coming month. There's a big Russell rebalancing that takes place every June, so perhaps that pushes a little bit more interest in some of these names, so that might work against us. But what I did in this particular case was selling a bear call spread, and I did it in the month of June, and I believe the strikes that I chose were the 228, 230. So I sold the 228, I bought the 230. That puts us right back to where it struggled to get above back here at the end of April. So that represents some sort of a resistance area, just in case I'm flat out wrong about this. Right now, this chart looks like it wants to go lower, if I had to guess. But obviously, I've been wrong before, and I'll be wrong again in the future. So if I'm wrong in this case, and we go up to this level where we had resistance over here, that can maybe be one more excuse for sellers to enter into the situation. Remember, we kind of needed that the last time I did the trade. We had a situation where I think I did the bearish trade on it over here. We immediately looked like I was going to end up being wrong on that trade, but we had a really solid sell-off going into the expiration period there for the month of May. So sometimes that can happen, but you do have to sometimes remain patient with those trades. In this case, I like the way this is setting up bearishly at this exact moment in time. And by selling a bear call spread, I have a defined risk way to take advantage of that. Remember, the whole point of having the 230 call as a bought strike within that vertical spread is if it does explode way beyond 230, I'm covered. So I don't want that to happen. I'll still take a loss, but I won't take incremental additional losses beyond 230. That's the whole point of selling one strike and buying another. The bought strike is my insurance policy. The sold strike is the driver of the trade. So what I want to occur for this particular trade is for IWM to stay below 228 between now and the middle of June. And if that can happen, then this trade would end up being a winner. So I hope you enjoyed my analysis here today. An interesting day that started promising but ended quite weak. Not a great sign there as we head into the final month, or I'm sorry, the final week of May here. So I appreciate you checking out the video. If you enjoyed it and you want us to continue to do these videos as often as possible in the future, I ask one simple thing out of you. Just click like for us there on Twitter. Thank you so much. I look forward to working with you down the road. Have a great night, everybody. Take care. Bye-bye.